Hey there, everyone. It's Joe from Ainslie's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainslieBullion.com.au. Today's topic is biggest dovish shock since 2008, why RBA shocked the world. Of course, we have Chris Tipper here to break down the morning's news posted on the Ainslie website. We'll put a link below for you to follow along. And joining Chris today is regular Ainslie team member Josh Lang. So, gentlemen, over to you.
Thanks, Joe. The Reserve Bank of Australia helped send global markets surging yesterday after only raising rates by 0.25% compared to the widely expected 0.5%. The question now becomes, is Australia leading the way, showing the rest of the world that maybe the rate raising cycle is behind us and we're moving into that much anticipated pivot? Or did the RBA just make a policy mistake that will be punished by the markets, as we witnessed over the last couple of weeks with the aggressive response seen in the UK bond market when it was perceived that they got it wrong and were going to fall behind? Today, Josh joins us after digging into the latest moves and the potential implications for us here in Australian markets, but also more broadly, with the price of silver taking off like a rocket and so far holding those gains and gold following suit. It's starting to get really interesting. So thanks for joining us, Josh.
My pleasure. No problem.
Let's get started with that rate hike. What happened there, and how did you come to interpret that outcome?
Yeah, so it did come as a surprise to most who expected it to be 0.5%. The decision to slow that rate increase, I thought, was pretty interesting, considering that even in the RBA statement, they said that they still expect inflation to increase over the months ahead, before coming back to that 2 to 3% target range. I thought it was very interesting that they aren't going as hard, even though they think it's going to keep increasing. So yesterday was the first time since their initial hikes in May that they've raised rates by less than 0.5%. I think this arguably is them factoring in the mortgage stress that Australians are experiencing so far. The average Australian's seen, I think I read about $700 in increases per month for their repayments. Australia, with some of the highest income to debt ratios in the world, it just looks like those rate rises aren't going to, stop increasing in the near future, which is just going to cause some more pain. So while we have only increased by 0.25%, it still does actually cause immediate pain for people with mortgages, and which has, ripple effects into the rest of the economy here in Australia. RBA is forecasting inflation around 7 to 8% over 2022, a little over 4% next year, and about 3% over 2024. Don't know how they're making those forecasts, but that's what they're saying. But if we're judging it by that, we're looking at a multi-year fix to get out of the corner that the economy sort of backed itself into here. So for people in Australia, don't expect interest rates to come back down to those record lows for a while. It's not going to be a quick fix. And pair this, with the fear that our local currency might lose more ground to the US dollar, it sort of just makes those inflation pressures and risks a bit worse for people. I imagine this is why our office has been pretty busy these last week, really. People are moving a lot of money into gold and silver to lower their risk of losing value in the AUD. A lot of people come in talking about the British pound. I'm sure they're just terrified of that situation, really weary of losing value due to the risk of currencies in the current macro sort of climate.
Yeah, I agree with that. And I know it has been really busy here with the gold and silver. I suppose we've looked at that British pound example where it absolutely decimated the currency where they moved that bit early. So the flip side of that, of course, is the US dollar. So is the US dollar the bigger picture here, right? I know we like to look at our own currency and we say, well, that move in the pound was very much a specific pound thing, but the trend was already in place with that US dollar really putting pressure on it, the same as we've experienced with the Aussie dollar. So how do you sort of see the US dollar playing into this?
Yeah, we sound like a broken record, the way we always talk about the US dollar at the moment, but it is in the driver's seat, so we sort of have to. But US dollar slid against most major currencies yesterday as the yield on the benchmark 10-year treasuries fell. This provided some risk on assets, some relief. We saw ASX up 4% yesterday. Crypto enjoyed the relief too. Bitcoin up also 4% overnight as well. It's still somewhat of a bold call to say that, the relentless US dollar strength is over, but there are starting to be things that weren't here a few weeks ago to suggest that, it may be coming to an end. On Monday, the Bank of England, they reaffirmed their willingness to buy long-dated gilts in order to sort of save their bond market and prop up the pound after what we spoke about last week, where it was just getting decimated. This is kind of the return of QE, even though they say it'll just be, temporary, just as it is every time. Something a lot of people are, skeptical of, because it's always temporary until it's not. So many think that the UK has sort of opened the door for everyone else, all the other central banks, to follow in their steps. Maybe here in Australia too, we might think that decrease in how quickly we're hiking is the start of that. That we could start seeing QE being brought back to save local currencies. So the moves in the dollar and the yields appear to be sort of partially reflected in the market's views and, the views for the outlook of the rates. They seem to be hoping that recent economic growth concerns may be enough to force the Fed and other central banks to become a bit less aggressive in their fight against inflation, something which, like we said, we've seen here in Australia already. But at the same time, that's just what is causing so much sensitivity and volatility, particularly in currencies at the moment, which, affects everything.
Yeah. And I know a lot of analysts have been saying there's nothing more, you mentioned about the QE potentially being temporary, and there's nothing more permanent than a temporary government program like quantitative easing. So yeah, absolutely, that pressure from the US dollar is difficult to measure whether that's finished or not, because there's a lot of factors at play that really are slow, like you pointed out, slow to turn around. They don't turn quickly. One of those things I think is job numbers, and that was sort of part of the news today, looking at those job opening numbers. So what did you find in that analysis? Is there anything useful there we can look at?
Yeah, I jumped into it after reading today's news because it's not something I sort of follow too closely. But what I learned was that US employers cut more than 1 million job vacancies in August, a sign that the Fed's aggressive efforts to cool the economy has actually begun to hit the labour market. So the monthly decline was the second sharpest in 2 decades of data. The only one larger was April 2020, when we all got put into lockdown and couldn't do anything. So that froze hiring, obviously, when the pandemic really kicked off. The only thing to keep an eye on in terms of job reports is on Friday, we have the official jobs data. So a lot of investors will be closely watching this, including myself, now that I know all about this, to see what sort of results come from that, because it seems to have a very heavy influence on what the Fed's path forward is. So if the data shows that they haven't broken the labour market yet, whatever that means and wherever the hell they draw the line, the market will likely start to price in that the Fed will continue to aggressively raise those rates. So from what I've learned, the labour market is very complex and can actually contribute to inflation as well, can heat it up, but it's sort of a balancing act for the Fed. So it'll be very interesting to see what they do there. So keep an eye out for that Friday report, mate. We'll see how the market reacts.
Sure. And I think you're right there. It's a really difficult one when you're talking about employment, because the Fed does have that, and central banks around the world really do have that dual mandate where they need to focus on employment as well as inflation. At the moment, the focus is entirely on inflation, but when that starts to hit on employment, we're going to see where they really stand, because you ultimately are going to have a lot of voters who lose their job. So, the political pressure starts to really mount when the jobs start falling. So that's something we definitely do need to be paying attention to. The other figure in there that's been getting a lot of attention, and I think would be interesting to look at, is those ISM numbers. So can you just remind us what the ISM numbers are and tell us a little bit about what's happening in that area?
Yeah, so ISM is pretty simple. 50 means no growth, above 50 means growth, below 50 means it's not growing. So put it simply, ISM for this last report was way below expectations. Everyone was expecting a result around 52, which would mean growth, but we actually got 50.9, down from 52.
So right on that midline.
Yeah, exactly. It's growth, but not very
not
much.
Really. Yeah.
So just for everyone, again, I'll go over that. The ISM, it's a monthly indicator that the US economic activity, based on a survey of purchasing managers from about 300 manufacturing firms. So the respondents there asked whether activities about their organization, if activities are increasing, decreasing, staying the same. It's sort of an index that's considered to be very basic, but also very important as an indicator for the state of the US economy. So I think some of the slowdowns in this latest report reflect the rotation we've seen from spending away from goods to services. So there's a lot higher borrowing costs now, of course, with the interest rates going up, and that's undercutting spending on big ticket items like household appliances, cars, furniture, which are all sort of typically bought on credit. Construction also not spared because it relies a lot on loans. And there's been a separate report from the Commerce Department on Monday, which showed that spending fell by the most in over a year and a half in August, as sort of single family household, home building tumbled to about 2.9%. So again, everything all comes back to, the higher borrowing costs, weaker demand. That's all stemmed from QE that happened a few years ago. So even though, it's temporary QE, always comes back around and hurts you later.
Yeah. And we'll continue watching the Fed and the central banks, try and solve the problem that they ultimately created, which is what you're saying there, isn't it?
Exactly.
Yeah. All right. Well, thank you so much for that, Josh. That's a great sort of overview of where we are at the moment, and a lot more data. And we'll be paying attention to that number you pointed out for Friday as well, because that'll be important. So thanks for that. And we'll talk to you again.
See you, mate.
Well, thanks, Josh, for being on the show. And Chris, I'll see you on the next one. And for the audience out there, head over to the Discord channel. That's discord.gg/gold to continue the conversation. Josh and Chris will be on there for the next 1 or 2 hours after the upload of this video. So it's the perfect way to ask your questions, get some answers in return, and also give your feedback. We'd love to hear from you. I always want you to subscribe to the YouTube channel, youtube.com/Ainslie Bullion, for the wide range of informational videos, 5 days a week, daily videos. And of course, head over to goldsilverstandard.com. That's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care. We'll see you next time.